into discussion about the markets and the way forward with Rakshit Ranjan of Marcellus Investment Managers. Rakshit, hi, good to be speaking with you. Well, I'll directly get into stocks because I look at a couple of your holdings, especially Asian Paints and Titan, and both of these two are going through industry disruptions at this point of time. Just this morning, Investec wrote on the paint sector talking about how Birla Opus is getting a lot of good response from customers. Titan, of course, is going through its own lab-grown diamond disruption. What then still makes you hold these stocks?
Yeah, sure. So both of those are slightly different in nature. Titan is an industry disruption, as you rightly picked it up, whereas Asian Paints is a competitive intensity rising significantly. They're two different parts of how a business gets affected. On Titan, I mean, the reason why we've actually significantly trimmed our exposure in the last 6 to 8 months has been precisely this this uncertainty that is rising on the horizon. It's a very small position now, but Titan is a company which is working on multiple engines of growth. They've proven via Carrot Lane what they can achieve in small ticket jewelry, and we'll wait and see how they progress with opportunities that maybe the lab-grown diamond disruption it actually brings about for even incumbent players. So it's a bit of a wait and watch there. Whereas in Asian Paints' case, yes, there are margin headwinds that we've seen in the last quarter. At the same time, there's a industry slowdown as well, where consumption, particularly in home building materials sector, has been significantly weak in the last couple of quarters. There again, I think from a long-term perspective, and we are long-term shareholders in companies that we own, this is a headwind for a few quarters, but from a long-term perspective, I think we don't see Asian Paints, the quality of the company, the quality of the management that it is, not doing well. I mean, we see them doing pretty good. So that's the view, and there's also a broader portfolio tilt that we've made related to the points you're picking up on Asian Paints and Titan, where we've moved away from consumption in our portfolio exposure and moved into industries such as, say, pharma, diagnostics, hospitals, private capex around manufacturing, around exports. We've added an IT services play. So that's how we are. We are tilting the portfolio away from some of those sectors which are adversely affected in the near term. And this is a position sizing approach, trying to benefit from opportunities in the relatively near to medium term. Long-term perspectives are different from that, which is why we keep holding on to some of those stocks.
Okay, Rakshit, when I take a look at your portfolio, and I want to keep going about the consumption space, I see names like you have Metro Brands, you have Titan, Trend, but when you take a look at pure play FMCG, you only have Tata Consumer among your top picks. Is this how you want to play the the consumption space going ahead? Stay away from pure play FMCG and rather have names like Titan, Trend, the likes of footwear, retail, jewelry. Is that how you would continue to prefer to play the consumption space going ahead as well?
So in general, the way we want to play consumption space is not through companies which are only doing more of the same on an ongoing basis. Consumption is an industry where penetration levels are far more advanced compared to 10 years ago or 20 years ago. It's also an industry where the external environment in terms of how the companies reach out to the customers, the channel is getting disrupted. The pocket spends, the allocation of spends into categories is also shifting, particularly post-COVID. The consumption pie of different sectors that take share of a household's pocket is different from what it used to be pre-COVID. As a result, companies which are far more agile with their capital allocation decisions and can, as a result, create flywheels of additional growth drivers once every 3-4 years, those are the ones that we are playing out. So Trent, as you mentioned, from West Side to Zudio to potentially Star Bazaar is a new engine of growth getting added to that business. Tata Consumer is a small position, yes, but it is again on the same theme. Tata Consumer is a very different business compared to where it was even till last year, and very, very different from where it was 4 or 5 years ago. And it's this capital allocation intensity of some of our consumption picks, which is what we are trying to play, rather than the standard FMCG of a little bit of market share gain in the existing categories and nothing new in terms of capital allocation beyond the core.
Rakshit, you talked about how you've trimmed positions when it comes to Asian Paints, Titan, and a few others as well. So talk to me about some of the recent changes that you have made in terms of where you have added the exposure, or any fresh name that you have added, or where you've increased the weightage and the areas where you're cutting down.
So there are two broad categories where we've added exposure. One, as I was mentioning, hyperactive and prudent capital allocation decision making. So for instance, even beyond consumption, we've added in the last 6 months exposure to stocks such as Tube, Aisha, etc., which is again an example of companies that are changing their engine of earnings growth at a consolidated level through capital allocation. And the second category is we've also taken exposure to a few sectors where growth has to come via market consolidation as well, which in many cases might even include M&A. And if there are companies in those industries which have monopolized some of their existing business areas and are sitting on cash as big as, say, 8 to 10% of the market cap, with demonstrated ability to integrate expansion beyond the core, including inorganic, that's where we have taken a little bit of exposure. So, for instance, CMS Info is a financial services play. It's more a sort of logistics superiority compared to competition, with lots of new business lines getting created through cross-sell, upsell of skill sets to similar customers. Alchem, Escorts, these are some of the other sort of names that we've added in the last 6 months.
Okay, Rakshit, when it comes to the entire healthcare, the hospitals and the diagnostic space in your portfolio, I'm seeing a couple of names like Divi's Lab. You have Dr. Lal Path Lab, as well as Narayana Rudolai. I'm not seeing any major pharma names coming in across your portfolio. What's the outlook on pharma going ahead, especially all the buzz that we've been hearing about CDMO players and also on the diagnostic space?
Yes, so Divi's is the best CDMO player by far. I don't think any other CDMO player comes close to Divi's in terms of quality. That's our view. What Divi's has managed to do is add newer CDMO drugs under their belt very consistently, at the same time expand their turf in the generic API manufacturing as well. It's a business where, in fact, there's massive operating leverage as it goes through the upcycle of adding new drugs to the pipeline on the CDMO front, which is the phase we believe it is in. So from that perspective, I think Divi's is probably the best exposure we believe we can have on the CDMO front. Beyond that, I think our healthcare exposure is more, barring Divi's and Alchem, it's more on the hospitals and diagnostics front, as you rightly mentioned. These are very underpenetrated categories where compared to pharma, particularly Indian domestic pharma formulations, and with the underpenetration of hospitals, underpenetration of diagnostics. You've got some of these companies that are there in our portfolio where we believe the business model is something that competition has found very difficult to execute. It's operational excellence, using technology, using processes, using systems that both of these companies have managed to deliver. And bulk of the benefits of those operational excellence have been passed on to customers. So for instance, if you look at the average revenue per patient of Narayana, it's a small fraction compared to some of the other larger listed names out there, because of the operational excellence being passed on to customers through lower price points. And end of the day, in healthcare, there are lots of stakeholders beyond just the patients. You've got insurance companies, you've got government, etc. In the long run, this kind of a business model where operational excellence derives efficiencies which get passed on as lower price points to the end customer, it satisfies the government, the insurance companies, the patients, and becomes a differentiation which is not very easy to replicate. So that's the theme we are picking up in healthcare, rather than Indian formulations only, where in many cases valuations have already skyrocketed with earnings growth in Indian formulations for some of the companies not exceeding mid-teens at all. So that's why we are staying away from that area.
Okay, point taken. That does make sense. Thanks so much, Rakshit, for making time and speaking with us today. So that's the latest coming in from Marcellus Investment Managers. With that,
if you like this video, then like, share and subscribe to ET Now.